Hi, it's Brian Decker with your Market Minute. Want to update you this week on the Jackson Hole conference that's going on right now, ended this week with Chairman Powell of the Federal Reserve, talking about how he's going to lower rates. We don't know if it's a quarter point, half a point. Several things are attached to this. Number one, you're going to be enticed to stay short term on your investments because right now the Fidelity money market's at 5%. 1-year CDs are at 4.25%. So that's an inverted yield curve. You're enticed to keep your money short. We do this for clients in cash management. Now's the time to lock in for emergency cash, discretionary cash, bucket one, to try to lock in 9, 12, 18 month CD rates, number one. Number two, on the equity indexed accounts, the annuities, the participation rates are multipliers of the index returns. In my 39 years in the business, I've never seen participation rates this high. When interest rates go up, participation rates go up. When interest rates go down, participation rates go down. So right now we're seeing participation rates for the first time in my 39 years of 300%, 3x what the index earns. Let's say the index earns 4%. Well, you multiply that by 3 to get 12% is what they actually credit you. So these are very high participation rates. This is also a good time to lock those in, either through upgrading your annuity from an old one of 3 or 4 years ago. We're doing that and have been doing that for the last 9 months. So we're helping our clients get that done on the equity indexed accounts. So we covered CDs, we covered equity indexed accounts. Now what this means is in an inverted yield curve, when the Fed starts cutting rates, that's when the clock starts. With 100% accuracy in trailing history, that's when the alarm bells go off for the recession. So usually within 9 to 12 months of the first Fed rate cut, we're going to see the definition of a recession, by the way, is 2 back-to-back quarters of negative GDP growth. That's the definition of a recession. Well, what's the big deal about that? Well, the average return of the S&P in a recession is a minus 30%. So we're watching for this. We're hoping for the best, but planning for the worst. So several things are happening right now when it comes to the first Fed rate cut. And we're doing all those things. Cash management, we're locking in 9, 12, 18-month rates. Number two, we're upgrading all the annuities. And number three, we're hoping for the best, but planning for the worst on the stock market. So it's Brian Decker. Hope you have a good week.